Broadcast is now starting. All attendees are in listen-only mode.
Welcome, everybody. Charles Heuring here, COO, Director of Business Development for IAMS Wealth Management. Thank you all for coming. Really appreciate the time you're taking today, whether you're watching this live or on a subsequent recording. We appreciate you taking some time to learn a little bit about us, a little bit about our platform, and how it can, hopefully in a roundabout way, help you grow your business, whether you're maybe new to assets under management or a seasoned advisor just looking for a new partnership or a new kind of mindset of how you're looking to grow. So with that said, we're going to go for about 30 to 45 minutes today, just talking about the platform. I wish I could get into every little detail in that amount of time, but unfortunately I can't. We have a pretty open architecture platform, so there are a lot of capabilities that we have. Today I'm hoping just to kind of touch on at least the high-level overview, just to give everyone listening a pretty good concept of what you could expect by being an advisor with IAMS Wealth Management and utilizing our platform. So if you have any questions throughout the webinar, definitely feel free to write those in. I'll get to as many as I can at the end. And if you have any specific questions and you're typing those in, don't feel like I might be skipping them. Those might just be better for one-off, one-on-one follow-ups too, which we will get to as well after the webinar. So before we start, the number, as always, is at the bottom of the screen. That'll actually ring directly to our wealth management team. So I know we have our usual 800 number for the IAMS side. The number below on these slides is for IAMS Wealth Management, and that number is 888-255-7670. So if anything you hear today kind of piques your interest, increases your curiosity about anything, or if I'm breezing through a topic and you want me to go in a little bit more in depth on a follow-up session, more than happy to do that. So with that said, we'll kind of get rolling here and talk a little bit about our platform. So initially what we set out to do as an advisory firm was develop a platform that can complement our advisor's insurance business. And just to kind of give everyone a little bit of a background of what we are, IAMS Wealth Management, we are a registered investment advisory firm offering security solutions for advisors. I know a lot of you listening may have your securities license and be doing this type of business already. A good amount of you listening maybe have thought about getting a securities license or maybe never even considered it, but are just exploring their options. What this does require is a Series 65 license to join IAMS Wealth Management and get access to this platform. I'd like to preface any platform discussion with that. It's not as easy as just getting kind of contracting with a carrier. You need a securities license to do this line of business. So we do have study programs available. We can talk about that at length at the end if anyone has more questions. But with that kind of now known, what we wanted to do is just develop a platform that can complement that existing business that a majority of our contacts utilize, whether you're on the advisory side or just the insurance side or a little mix of both. We wanted to give a platform that could complement that. And with that in mind too, kind of the second bullet point here, we want to develop a platform that is not going to overhaul anyone's existing business. Whether you're been doing this for 10 years and you're on the asset management side of things, or you're getting your first step into securities business from being kind of an insurance or maybe annuity salesman. We don't want to overhaul your business, meaning we're not going to force you to be someone who wakes up every morning, checks the markets, looks for trade signals, then recommends trades that way on a daily basis and completely revamp your lifestyle. What we like to call our advisors are more of asset gatherers rather than asset managers. We want to be that asset manager for you. We want to be that go-to partner using the systems that we have here in our platform to allow you to really do what you do best, which is managing your client relationships and building out your business that way. So that was an important mindset for us from day one. The third bullet point here I think is key as well. Obviously we want to develop a platform that is simple, at its basic form, but yet be able to be built out for anyone who might be a little bit more savvy in investments, or for even someone who's, relatively simplistic with investments, but has those one-off clients who need a pretty customized solution. We like to think we have the best of both worlds. We have a very simple platform that no matter how complex or intricate you really need to get on either a book of business basis or a one-off client basis, we have the capability to do that with the partnerships that we have. So I always like to touch on that. And then lastly, we wanted to develop a platform that implements a consistent plan. And this will come into a little bit more highlight in the next couple slides. But what we didn't want to do is just kind of have a platform that, 1 month or 1 quarter has a certain mindset, the next quarter has a different mindset, and kind of jump from idea to idea. just because, as I'm going to show you here in the coming slides, a lot of times emotion or maybe chasing performance can get you into more harm than good when you're trying to manage assets. It's usually best to have a consistent plan that is utilized over time after time after time to give you the best overall chance at long-term success. So that's kind of our mindset there. But kind of talking about the role of volatility plays, I always like to cite these numbers. And if you've been to any one of our IAMS academies, or if you've been to one of our advisor meetings, these are numbers we hammer home pretty hard, just because I think it does speak volumes to kind of just the natural tendencies that maybe the usual retail investor has in comparison to what maybe they think they're able to complete just on the investment side. So if you're looking here, here's just some figures from a Dalbar study. It's a 2016 study, so it's getting a little bit outdated. But this is looking back at a time frame from 2011 to 2015, a 5-year period. The average equity investor underperformed the S&P 500 during that time by about 5.7% a year, or almost half. And then you're looking at the same thing on the fixed income side, underperforming the Barclays, just the standard index for fixed income, by about 3.15%. I mean, when you're looking at that in just terms of total return, the average equity investor missed out on about half of the equity return, and the average fixed income investor missed out on about 97%. And that's not because they're any less smart or more smart than any index out there. Typically, this falls back on just the fact that in investing, what's comfortable is rarely profitable. It's easy to be emotional during upswings, thinking that a downturn's never going to come. It's easy to be overly pessimistic in a time of a correction, thinking that the bottom's going to fall out. What you need to be able to have is a consistent strategy that can work over time. So that's kind of why we developed our platform the way we did. And just kind of one more figure I always like to cite is that I think majority maybe of clients out there don't have a complete grasp of how often volatility occurs. I know, for example, looking back on 2018, that was about the most volatile year we'd seen in recent history. I think a lot of people find that to be maybe abnormal, when in reality, that's kind of just the long-term average. It was just coming out of a time where we had seen very, very diminished volatility for an extended amount of time. So we like to have our advisors kind of talk about these statistics with clients. If you're talking to a client or doing some sort of presentation, it's always a good question to ask, how often do you think a 5% drawdown occurs? And usually you see hands raised and people might say, every 8 months, every year. Well, in fact, it's actually about every 3.3 months, so 3 to 4 times a year. Again, you can talk about a 10% drawdown. I mean, that's just the amount the portfolio goes down, the amount the market goes down, 10% at any given time. That happens about every 18 months. So when you're talking with clients, they have to understand that every 18 months, if they're invested in an index, S&P 500, for example, they're going to see a 10% drawdown about every year and a half. And that's just the nature of kind of investing. And going down here, when you put it into tangible dollar figures, it kind of becomes a little bit, I think, louder for a lot of people, just because risk tolerances for clients do change when they see it on maybe a recommended proposal versus when they're seeing it on their statements they're getting. But all this is meant to do is just really highlight the fact that volatility does play a major role in investing. It plays a major role in the markets, and you're never going to completely eliminate volatility, but the best you can do is try to hope to mitigate that best you can. And that's kind of our method here before I go on to really talk about our platform in detail. We always like to say that we understand that no investment comes without some type of risk. But the goal of any investment strategy should be to design a solution customized to whatever risk tolerance your specific clients have, whether they're long-term focused, short-term focused, looking for growth, looking for preservation. You need to be able to have a consistent plan that can meet all of those goals, and that's kind of where our platform comes into play. So as we're talking here now on just our platform, I do like to say that there's kind of 3 various tiers that advisors have access to, and this spans kind of the levels of I guess, hands-on capabilities that the advisor is looking to have. I like to say that our core platform is just as simple as advisory business can go. It's going to be leaning on kind of the standard fixed income equities allocation, leaning on our firm to help you with a risk-adjusted proposal and portfolio and ongoing management. It's going to be pretty hands-off, but it's going to be a turnkey solution for you to add into your business to nicely complement what you're already doing if maybe you've never done this before, or if you are doing investment advisory business elsewhere. It's likely going to be a little bit more efficient, less time-consuming for you, and allow you to grow at a little quicker rate than you might be currently doing. Kind of building off of that, we like to say we have our Core Platform Plus. It really handles all the same capabilities of that existing core platform, but it's going to give you those satellite options that you want to be able to really hone in for an individual client's needs, or maybe use a different outside manager if you're looking to maybe get a little different exposure on the equity side, for example. And I'm going to get into all this in just a little bit, but I just like to talk about this at a high level overview at first. And then lastly, we have our Premier Advisor platform. So for those of you advisors out there who are, very experienced in investment management, have done this for a while, are used to having a little bit more hands-on feel on your book of business, actually like having that hands-on feel, like doing the investment research, like doing your own trading, managing your own models, we have an outlet for that too. So we'll talk about that here at the end today. So without further ado, I'll kind of talk about the three various tiers of our platform here. So just our core platform, at its simplest, kind of focuses on these three different ideas. One is obviously the focus on a suitable risk allocation, what I touched on already a little bit. The risk-based profile system is going to allocate your client's dollars to a risk level that they are comfortable with and understand, meaning that the process is always going to start with a risk questionnaire that's going to turn their risk tolerance into a quantifiable risk number. And that's going to at least be the initial starting point for where the conversation goes. By that risk number, you'll be able to tell if they're long-term focused, maybe growth-minded, or short-term focused, preservation-minded, and just looking for income. Square one is always focusing on that suitable risk allocation. Step two goes back to that volatility conversation we briefly had, just talking about how our core strategies trade, meaning that we're not letting emotion or bias really get in the way of our core investments. It's not like me or our team here, or even the money managers themselves, are picking and choosing individual stocks, mutual funds, ETFs on a weekly, monthly basis on kind of a whim or a gut feeling. We're relying on a repeatable, rules-based algorithm that's going to be designed to invest when the market is in an upturn and go defensive when the market is in a downturn. It's never going to be perfect either way, but the goal there is to win consistently over time. And just because we think that gives the clients the best chance of success when you actually remove emotional bias from that equation. So we'll talk about how our strategies trade here in just a minute too. And then lastly, I think this is key for a lot of advisors in the business, is just really setting the table with risk-adjusted performance and setting achievable expectations for your clients. I think everybody understands that one of the worst things you can do in any client relationship is overpromise and underperform. So it's very key from day one just to set realistic expectations, not only for performance, but maybe for volatility, for various aspects of the portfolio, the role it plays. I mean, obviously, you're not going to put 100% of your clients' net worth into the market. You're going to find a way to make a financial plan that's going to maybe complement it with an annuity or life insurance, various ways to build out that kind of whole cohesive plan, where a client then understands that they're going to see some volatility maybe in their investment account, just because that's the purpose of what this is trying to achieve. So that goes back to just setting the expectations right from day one, because that's going to make everything easier down the road. So that's kind of our goal there from the core platform. With that in mind, I like this slide just because it's overly simple, but that's really what the core platform is. For anyone who might be brand new to it, this is just a simple way of our core platform using two different of our strategies, one of our equity strategies, one of our fixed income strategies, putting them into a kind of a two-piece pie that's going to be managed according to their risk tolerance. And that goes into a little bit more detail on this slide. As you can see, someone who's more aggressive is going to have a higher risk score. They're going to have a higher tolerance for risk. They're likely going to have a longer time horizon. They're going to be recommended to invest in a little bit more of the equity side. They're going to take higher upside, knowing that there's more downside that could come with that. Same goes on the other end of the spectrum. If their risk score is low, meaning that they're likely up there in age, they're needing their assets sooner rather than later, their time horizon's a little bit shorter, they're going to be invested a little bit more conservatively, more on the fixed income side. And you can see here's some target returns net of fees that we kind of set the table with, is just saying, some years are going to be more, some years are going to be less, but this is what we're targeting to achieve with these core allocations. So I like to say that, if you're looking at this piece or this slide, it does look overly simple, but that's really, I think, all it needs to be in a lot of cases. I think some people confuse having 30 different holdings with diversification. A lot of times that's not always the case. I think a lot of times that maybe there's different asset managers out there that utilize that strategy just to make it seem like there's some added value to their portfolio, when in the end you can really boil it down to being very simplified, at least at the core. These strategies invest in anywhere between 3 and 5 ETFs at a time. So there's going to be that diversification that changes on a monthly basis. And we'll talk about that here in just a little bit as we're going through how these strategies actually trade as well. But with that in mind too, going on to our core platform plus, it's really just a branch off of our core platform that those 10 different profiles. You can throw in some satellite objectives. And what that means is that you're obviously going to come across clients that have needs outside of just their standard equity and fixed income investments. You can see some of them listed down here below. Some of them need a safety investment. Some are looking for, specific growth of capital. Maybe some have an affinity for real estate. We do have outlets for that as well that can complement the core allocations. And we're going to talk about that here on this slide. As I'm assuming majority of you watching know, some safety investments, that's going to be a lot of your annuity business. If you have a client with $100,000, they want to put $50,000 into an annuity, that's kind of their safety allocation. And that just means the other $50,000 that's in the equity side, the market side, you can go a little bit more aggressive with that, just because it's going to complement the entire household according to a client's risk tolerance. If you have certain clients looking for income, a little bit more, maybe dividends than what the core strategies provide. We do have some clients that, we have in dividend paying stocks that are going to be their income, or high yield bonds. Moving on to growth of capital as a nice little satellite complement to the platform. If someone's in a profile 8, for example, they're pretty high in equities, but they want to put about 10% into a growth strategies or maybe emerging markets just to potentially get a little bit more growth as a diversifier. We can do that too. That's just the capability we have on the platform. Same goes for real estate. I won't touch on it too much now because I'm going to be talking about a real estate aspect later as kind of a nice marketing tool. But we have access to real estate or tax-centered satellite allocation. Maybe some people have some unrealized gains that, of course, you don't want to sell just to get capital gains. Maybe the mindset for that specific holding is just to pass on to the next generation at a step-up basis. We're never going to liquidate that just for the sake of liquidating it. We're going to make sure the goal that they have is customized according to their specific needs. So that's really the point of the Core Platform Plus, is that for those intricate advisors who want to have a little bit more capabilities or a little bit more leeway with how they manage assets, this is just a really easy way to do that. Or for someone who maybe wants to keep it simple, is going to use the core platform as their bread and butter, but has one client who specifically says, I'd really like to get some exposure to real estate. Well, this is an easy way for you to kind of tie that in there and not have to turn the client away and say, sorry, I don't have anything for you, I don't have access to that. Through the IAMS Wealth Management platform, you do. So as you can kind of understand now at this point, the core profile is going to always be where it would start. In this instance, this couple they scored out to be a risk profile 6. That's where their core profile sits. They do have an affinity for real estate in this case, so they want about a 10% alternative diversification into real estate. So we get them tied up in there. And then it's a customized allocation. And you can see, it's a 90% is going to be in that core. 10% is just in the satellite alternative allocation, but it's designed for their needs. It's risk adjusted. It's developed for their goals. It's customized. Everything you really need. And the nice thing for you as an advisor is you really don't have to go out of your way to manage this on an ongoing basis. The upfront work is really assisted by our team here as you're recommending it. Getting the business submitted is assisted by our team here. And then the ongoing management is really handled by our team here. You as an advisor just obviously have to do annual reviews with the client to make sure if their goals or needs change, the portfolio can change with it. But again, I know I'm making this sound pretty simple, but at its core, at a high level, it really is. I know I don't want people to be intimidated that maybe you've never done market-based business before, thinking it's overly complex, it's too complicated, you don't have the expertise or the time. We've really developed this platform with that in mind, trying to take a lot of the time, the hassle, the liability off your plate and really do what we do best, which is serve the advisor, doing the best we can to help you grow your business. A little outside tidbit on our kind of core platform plus. this is just a slide I threw together with some of our strategic partners. I understand there's a lot going on here, and that was kind of the idea. I'm not going to go through these all, but I just like to include a slide like this just to let everybody know that through IAMS Wealth Management, you have access to a lot of different various money managers, different products, different custodians, different services. There's a lot of different connections you can make through kind of the IAMS wealth management group here. So just know that no matter if you have a 401k you need to manage, or if there's an outside manager that maybe you use at another firm that you'd like us to consider, we're more than open to do that. That's how we grow. That's the type of feedback we appreciate, and that's how we know what our advisors need to help their business grow too. So this is just a quick snapshot just to show you that you have a lot of different outlets when you're affiliated with IAMS Wealth Management. The one I want to highlight on quick that I mentioned a little bit earlier is just, for example, the Black Creek Group. They are a fund we have on our platform that invests in core real estate. And for anyone who might not be familiar with core real estate, when you look at this graph, you can see that commercial real estate is the third largest asset category in U.S. market cap, but majority of clients or prospects you come across are really not going to have any exposure to it. Just because the typical end client doesn't actually have access to a lot of these, commercial real estate funds that, a lot of the bigger accounts do. For example, if you look at any, large pension fund or usually any maybe college endowment fund, they're going to have about a 10% allocation to real estate when the majority of end clients have zero. And this is just a unique way that you can offer clients a interesting addition to their portfolio that they're probably not going to get anywhere else. It's a nice complement to what they're already doing. They can invest just like the big pension funds and the big endowment funds do, but at the end client level. And the nice thing for something like this is it has low market correlation. So whether you're in the upswing or downswing, it's not really going to correlate too much to what the market swings are doing. So it can kind of serve as that steady rock in the portfolio for your clients. So I like to touch on that. I didn't want to get into too much detail, but that's just a sampling of just one of the managers we have on our platform. If you're intrigued to know about some others, that's good for a one-off conversation. I encourage you to give our team a call. We'd love to talk to you about that. So here, as I talked about earlier, we're going to talk a little bit about how we trade those core strategies. So we have those 10 different profiles that span the risk spectrum. Profile 1 is very conservative, more fixed income based. Profile 10 is going to be majority equities, more growth based, and then everything in between as you go, 2 through 9 and up the ladder. But here we're going to talk briefly about how we trade our strategy, just because I think that's important for you to know if you're looking to do securities business and affiliate with a group that will be kind of your investment back office, so to speak. We utilize a term called relative strength, and I'm guessing some of you listening know what that is. Some of you listening maybe have never heard of it. And that's kind of the typical ratio we see. All relative strength is really a buy high, sell higher strategy that's going to consistently look for top performers and try to invest in those assets as their performance is good. But at the same time, it's nice that it has both an entry and an exit strategy, meaning that if the signals are in the market that the market's appearing weak, it's not going to recommend investments for purchase just because there's signals to be a weak trend. I think there could be at least a lull in the market, and that's just going to use its best strategy to go defensive in that case and try to preserve assets. So it's going to capitalize when times are good and ideally go defensive when times are not so good. And that's kind of the rationale there. To kind of speak on the kind of credibility of relative strength, we always like to talk about this graph a little bit just because it shows you the kind of benefits of using a strategy like this could include. So these are just 3 different investment styles that we can show you that involve relative strength. And the first line you're going to see here is just the holding SPY since the beginning of 2003. For those of you who aren't aware, SPY is just simply an S&P 500 kind of index ETF. It's just showing performance if you invested in the index and just kind of let things ride for the majority of time. This is kind of what your investable assets would look like if you started with $100,000. Now, if you threw a moving average in there, meaning if you're going to use a little bit of relative strength when the times are good, you're going to invest accordingly. When the times are bad, you're actually going to go a little bit defensive and sit on the sidelines. You can see that over time, the line is a little bit steadier, the trend is a little bit easier, and it gives your clients a little better idea of where their wealth is going to be over a 3, 5, 10-year period. Now, when you bring momentum into the fold, meaning that you're still using that same moving average indicator, but when the times are good, you're going to be striving to be in those top performers, the ones that are performing the best at the current time. That's when you can see it start to spread itself out over time. And that's kind of our goal here. This is just meant to give you a brief snapshot on just kind of the idea of relative strength and the various benefits it can offer you and your book of business and your clients. But I think it's helpful also to look too at individual snapshots, because people always say, well, how does it work in bull markets and bear markets? Well, here's looking at a snapshot of 2016 to end of 2017. If you're just invested in a market index, this is kind of where you're going to be looking at. I mean, that was a great 2-year period. If you're just investing in the market and you really didn't change much, you would have done just fine. If you're throwing in moving average or momentum, you can see you're still performing fine. You're probably not going to outpace the market. That's not what a strategy like this is designed to do. This is designed to participate in as much of the upside as you can where the times are good, just because you're inherently going to be protecting through the downside risk on the backside. So that's when the bear market comes into play. As you can see, a period like 07 to 09, if you're invested in just the market itself, there's a little bit of a dip there, a substantial dip, in fact. But if you're using some sort of moving average indicator or momentum, you can see that this is meant to ideally protect you from catastrophic loss. And that's kind of the mindset there. We'll sacrifice a little bit of the upside when times are good to ultimately protect the drastic downside. And that's majority of what our advisors come across, or at least the clients our advisors come across, is that specific need right there. So looking at our core strategies then, in kind of a nutshell, they're going to use a lot of those same rules that we just discussed. I mean, the way I like to describe it is, let's just say we have a bundle of ETFs that these money managers can utilize. Those are just described on the left as a sample. All ETFs go through a screen every time a rebalance occurs. And a rebalance on the fixed income side is going to occur monthly. So there's always going to be constant activity in your client accounts. On the equity side, it's going to occur either monthly or quarterly, depending on what strategies you want to go in. So these go through the quantitative screens that focus on price momentum, meaning what's the best performer in the current kind of market snapshot. It's going to look at volatility, meaning what's been the most volatile or least volatile in the current market snapshot, and then ultimately a trend analysis. So that's going to be looking over a longer term trend, trying to gauge the overall condition of the market. And if the various volatility, momentum, or trend signals appear good, it's going to invest accordingly. Same goes for if it appears bad, it's going to invest accordingly, and that would be defensively. And that means that your clients are going to be pulled out of harm's way and then put into a defensive allocation to kind of just wait out whatever negative trend that the signals are seeing. Just for specific sake here, the screen utilizes a 3-month and 20-day return, and that's that momentum factor that we discussed. It's also going to utilize a 20-day volatility measure to analyze the volatility of the underlying securities. And for any of you who might be new to this, volatility is just simply how erratic the price of a holding goes, how drastically it goes up, down. Usually, an investment that's a little bit steadier is going to have better performance and be a little easier for a client to swallow over time. And then lastly, that trend analysis I mentioned. We utilize a 5-month moving average. So that's nearly half a year of data that this continually looks at month after month after month, just to gauge underlying trends in the market. And that's really the synopsis there of how that screen works. So when you're looking at this in just a strategy snapshot, and I know this is complex at the surface, and we're not expecting everyone to understand this, just off of a quick 45-minute webinar. But again, this is just to give you a taste a little bit about how it works. Our equity strategy, for example, invests in 3 ETFs at any given time. So you can see here, if the market is performing well, if all the signals are appearing strong, we're going to invest in the top 3 ETFs that we have available in the strategy. Now, if the market appears weak, if there is a substantial downward trend, things are not looking good, the manager will allocate defensively. And that can be done defensively in a third of the portfolio, it can be defensive in 2/3, or even 100% defensive on the equity side. So it's nice because your clients will never have to wonder really why they're using you as a money manager or advisor, why they're paying you a fee, because it's continually getting looked at month after month after month, year after year after year. And as an advisor, I mean, that's a service you're bringing to the table for your clients, but you're not having to be calling us month after month requesting all this to happen. It's happening behind the scenes through our team and the partners we have here. We're trying to take as much as we can off your plate and allow you to really just utilize the platform as a way to build your book of business. So that kind of gives you a snapshot there on the equity side. And I like to use this chart too, because a lot of people say, well, how does this work over time? What does this kind of look like in a visual representation? And this is the kind of the best way we can kind of represent it. So that white line that you're seeing there that goes through the middle of the graphic here, and that's simply the value of the S&P 500 over time. As you can see, it's a gradual upswing, then it has some dips, but it typically over time is trending upwards. The various colors you're seeing in the background, whether it's light blue, dark blue, or very dark blue, that's simply just the asset classes of the 3 ETFs on the equity side that it can invest into. I would worry less about the asset class right now, what shade of blue each section is, and I would pay more attention to the various gray sections, just because gray is defensive. So if you're looking at a period from 03 to 07, the market at that point was strong. I mean, it was trending slowly up and up and up. A few dips or flat lines along the way, and you can see our equity strategy is pretty well invested fully, outside of a few quarters there where it maybe went a third defensive, just naturally go into that protective mode if signals were looking a little unstable. But the key part here is looking at a period from 07 to 09. When the trend appears weak, it's going to invest defensively. And in this instance, there's about a 6-quarter streak there of it being 100% defensive in short-term securities or short-term treasuries, pardon me. And it really allowed the strategy to kind of avoid a lot of the downside that that time naturally brought, I think, a lot of investors out there. And as you can see, since then, over time, it's kind of done the same thing, gone defensively in certain instances, stayed fully allocated. If you're looking at this compared to the value of the S&P 500, you can see it's never a perfect science. No money manager out there is. But we believe is kind of getting back to what I said at the beginning of the webinar, is that if you can develop and utilize a consistent plan that has the same plan month after month, year after year, you're going to give yourself a better chance of success than you would if you're just making gut impulse decisions as kind of your emotions dictate. So I always like to touch on that too as we kind of wrap things up here. So with that said, that's kind of our core platform and the core platform plus, where you're bringing in a little bit of the outside strategies and outside managers to complement. That's just a brief snapshot of how our core strategies trade. We have several different money managers on the core platform, so it's not really a one-size-fits-all. We're open to hearing about other money managers. There's a certain one you might utilize somewhere else. We're always looking for feedback that way too. So hopefully that gave you at least a good overarching idea of just the core platform itself and the different pieces you can put together to customize it for you and your business. Before I open the floor up to questions, I do want to just talk briefly about the IAMS Premier Advisor platform. And this is what I mentioned earlier about being kind of the more hands-on option for advisors out there who have been doing this a while, who are accustomed to maybe doing a little bit of their own trading, maybe managing their own models, and they're the ones who actually enjoy maybe doing a lot of their own research and buying and selling and choosing investments in that way. There's nothing wrong with doing asset management this way. There's nothing wrong with doing asset management the previous way, where you kind of offset a lot of that management. It's really up to the individual advisor and what you're looking to achieve and what you think is going to help build your business. And that's why we have options on both sides. That's why we have the Premier Advisor platform here that I'll talk about briefly. So this platform essentially just allows seasoned advisors a more hands-on grasp of their assets under management. Maybe some of you out there listening have a book of business that you utilize, maybe a money manager for a portion of it, but you like to manage your own models for the equity side or the income side, or you like to do a little bit more trading with various independent holdings for your clients. We have access to that through our Premier Advisor platform. Through that, you're able to manage your own models, you're able to trade your own accounts, and you're able to access additional tools. You can see a couple of the additional tools here on the graphic on the right, where you can trade at the account level. You can trade at the household level, or you can even update at the model level, where if you have a book of business that you allocate to your own 2 to 3 different models, if you update the model, it'll actually then subsequently update every client account. So it'll save you a lot of time if that's something you're familiar with doing in the past. I think this technology is second to none, really, when it comes to efficiencies and offering up more capabilities for you as an advisor. I will say I can probably imagine that some of you listening who have maybe never done asset management before, or looking just to maybe get started in it or pass your Series 65 and start, this is not something you're going to want to touch from day one. I think majority of you out there probably wouldn't want to, frankly, just because you don't want to completely overhaul your business like we talked about at the beginning. But we just want to talk about this just so everyone knows it's an option out there. This does come with a little bit more compliance ramifications when you're going outside of a traditional money manager route. So with that in mind, it obviously has a little higher threshold to qualify for something like this. I won't get into too many specifics just because it really is a case-by-case scenario. But we like to see somebody with long-term experience managing assets, usually a sizable book of business, just to make it worthwhile to go out and build out a lot of the additional tools that we need to make this successful and applicable for you. And then also someone who kind of has a pretty good investment mindset. They have a good grasp of why they're doing what they're doing. They can talk with us and our investment team here and kind of describe their goals for their clients and really kind of be a little bit more savvy that way. So that's kind of how I want to preface this too, is that it's an option out there on the platform. There will be a little higher level of entry there. There needs to be a little bit more experience to access it, but I know there's probably a couple people out there listening that would be interested in something like this, so I just like to touch on that too. Just to let you know that we can help any advisor, from someone just starting out looking just to pick up a couple extra assets along the way, or someone who's been doing this 10, 15, 20 years and is just looking for a new home that might make their life a little bit more efficient. We can help all extremes. So with that said, that's kind of the end of the platform discussion at the high level. I know I mentioned questions that at the onset that everyone wanted to ask, so feel free to chime in as we continue to talk about those. I have noticed a few coming in already, so I appreciate that feedback. But what I do want to touch on again is just kind of going over the overview of what it requires to offer this type of platform to clients. Again, it does require a securities license. So if you're maybe an insurance-only agent out there who's looking for additional ways to, I think, grow your business, I think having something like this at your disposal is a really, really intriguing way to do so. I think everyone out there obviously is looking for new ways to get in front of clients, new ways to market themselves, and I think too often maybe look at the next maybe social media campaign they can do, or the next seminar campaign they can do. And those are great ways, I think, to get in front of people. But I think adding investment advisory capabilities is an excellent way to kind of reframe your business. It allows you to go back to your existing clients and those relationships that you have, reframe yourself, gather additional assets from them, solidify that relationship, increase your referability because you're a one-stop shop for everything you can do. And then once you do that, really the growth snowballs from there. I know the advisors that I talk to on our team that have done this. We have some who moved over a book of business. We have some that started fresh with us from zero assets under management. But what they universally tell me is that by getting their securities license, by offering securities, has helped their business exponentially, just because they now no longer have to turn certain scenarios away, certain clients away. You're not going to write securities business every time. You shouldn't every time. Every case is a case-by-case basis, but all it allows you to do is really be that one-stop shop for your clients' needs, and this is a simplified way to do that. So that's why we kind of did the platform the way that we did. Kind of getting to the questions here. Someone asked about account minimums. That's a good question, just because I know certain RIAs or other firms out there have very, very high minimums, maybe only cater to high net worth clients. We try to fall somewhere in the middle. We state on our ADV that our minimum is $25,000 to open an account. We like that to be the minimum, just because we want to make sure that the time you're spending and the liability that you're taking on is kind of worth your time there from a small account perspective. But we do make exceptions, obviously. We understand that there's certain instances where a $4,000 Roth IRA account is very integral to the household level of accounts, and you don't want to tell somebody you can't take that account on. I mean, obviously you want to be their go-to resource. So there are exceptions made, but we like to say, as a general rule of thumb, 25,000 or more is usually what we like to see in a portfolio. As I'm getting to some more questions here, someone asked, what do the strategies typically invest in? Majority of the strategies we have on our platform invest in ETFs just because they're a little bit lower cost. The real estate option I talked about is a mutual fund just because that's more of a specific niche need. I guess long story short, it depends on what route you go and what managers you utilize, but we have access to everything. I guess that kind of leads me to another point that is a frequently asked question at a lot of the events that we do, is I think a lot of people maybe have a misconception that if you're only doing investment advice, let's say you're not a commission-based broker, if you're only offering investment advice, that maybe you can't offer your clients individual securities or mutual funds. That's not the case. You can include really any holding as long as it's actively traded on a platform on a custodian level. You can include those on your client portfolios. You don't earn a commission for that just because you're an investment advisor. You're charging a fee for your investment advice, so you can earn a fee on that asset in the client account. So if you have a client that you're moving over that has had their Ford stock for 20 years and they have an affinity for it, they never want to get rid of it, they wouldn't sell it even if it went down to a penny, you don't have to liquidate that just to bring them on as a client. You're able to hold that just like anyone else would. Same goes for someone out there who is working with you that calls you up on a random Wednesday and says, hey, I'd really like to get some holdings of Amazon. Can you help me out? Well, yeah, we'd likely have you sign an additional individual transaction form that you'd have the client sign, but in a matter of a few days, we could have that transaction issued in their account and they could hold Amazon. I mean, I guess that just kind of gets back to the same point, is that this is not one size fits all. It's pretty flexible. It's the beauty of having an open architecture platform. So I like to touch on that because usually I think that's a misconception that some people maybe don't realize, honestly. Another person's asking, is there going to be a recording of this? Is there going to be ability to get these slides later? There will be. So this will go on to YouTube, and I'm more than happy to send out any of these slides to anyone if you're looking to kind of get a little bit more information after this webinar. I know trying to do this all in a matter of 45 minutes is kind of a breeze, so it is probably a good idea to hear it a second and third time. But even if you want to call as a follow-up, me and my team, we're happy to answer any of your specific questions you have too. Some question here. It looks like someone's asking kind of how they can build off the IAMS Wealth Management, I guess, institutional credibility, for lack of a better term, as they're working with clients. And I think it's an intriguing point to bring up because majority of advisors that we work with and majority of advisors out there are really, one or two man shops. Maybe there's just an advisor and maybe a secretary, or maybe there's an advisor and kind of a sub-advisor who helps them write certain business. I think there's a lot of value to aligning with a firm like IAMS Wealth Management, just because we don't really pigeonhole you into doing it our way or the highway. We really want to help you grow in the way that you want to grow. And what I mean by that is majority of our advisors actually use their own branding. They use their own name out, the public-facing name. It doesn't matter if you're starting a new brand when you come on with us, or if you've had an existing brand for 10 years and now you're just wanting to add asset management into the fold. We want to help support you that way. And I think we can help give you that credibility that maybe certain clients would want to say, who are you? What's kind of your story? What's your background? Well, you're not just, Joe Advisor who might, be managing $1 million in Indiana. You're Joe Advisor in Indiana who is part of a network of 50 plus advisors who's managing $50 million in assets all across the country. So it kind of adds that credibility that way. And I know a lot of our advisors go even a step further with some of our marketing pieces, even tying in some of our other institutional partners. Our custodian, for example, that we use primarily is TD Ameritrade. I think, a lot of people might not know your company name right off the bat. A lot of people wouldn't know IAMS Wealth Management right off the bat, but a lot of people know TD Ameritrade, and that adds some credibility to you too. So as you come on board, we help give you those branded documents that can help solidify that relationship. But that's just part of kind of the IAMS Wealth process. So I could talk, 15 more minutes if I wanted to about some of the marketing that we do, but I don't want to take too much time today. But that was a good question, so I appreciate you asking that one. Good question on the premier tier, just kind of asking about kind of capabilities. I don't want to talk too in depth on that, just because that is a very, I think, specific need for a certain set of advisors out there. But their question more revolves around, can they build a model out of individual holdings, mutual funds, stocks, ETFs? The short answer is yes. Granted, you'd have to kind of pass the qualifications first, meet the additional standards for kind of access on that platform. You'd have to talk with our investment team, kind of giving them your mindset of why you're doing kind of some of the actions that you're doing. But short answer is yes. The long answer is there's some steps to that process, but it's doable. So appreciate that question there. Another question's regarding variable annuities. That's a great question too. I know a lot of the people that we come across who might be with other firms out there do utilize variable annuities. As an RIA only, variable annuities are available. It's just a little different. You're not earning an ongoing commission or trail. It's just simply a variable annuity for a fee. There are a couple different companies out there that offer them. We do have access to a few. I know there's some out there that we simply could get selling agreements with. It's not something we do a lot as a bread and butter right now, but it's definitely something that if you come across a need, our advisors have access to it. And again, that kind of just circles back to the same point earlier, is that we're open architecture. We're very open-minded for how you need to manage client assets on a case-by-case basis. So whatever you need to do to meet that customized solution, we'll help you get there. So good question on that. Another question's regarding kind of the ongoing training. I like these questions. These are great questions. These are the stuff that I usually like to spout off, but it's good that they're getting asked. So appreciate the questions. I'll keep going for a little bit if anyone wants to keep writing in. But ongoing training, that's a great question, just because we're not expecting someone to pass their 65 exam or move from their other firm and come to IAMS and maybe watch a webinar like this and know everything. We start every advisor off, no matter how seasoned you are, with one of our quarterly training events. We typically do those here in Omaha. We do a couple remote in various locations across the country, just because we do like getting in front of our advisors. We know that there's a lot of value to get everyone at least a core level of knowledge as a starting point. And that's kind of the purpose of those quarterly events. And even from those events, we don't expect you to leave and know everything on the platform and the systems, on the technology, like the back of your hand. Like I said, that's just supposed to be ideally a core level of knowledge. So that way, when you come across your first client situation, you can lean on our team, lean on us to help you from the start, meaning proposal process. How do you go about making the sales pitch? How do I go about even getting an application ready? I mean, we help you with that. We even pre-populate paperwork for you. So that way you can really just focus on making the sales pitch, getting your signatures where you need to, and getting the assets on board. Ongoing from there, I mean, once the assets are on board, we help you with ongoing management on the back end, whether that's getting your reports ready for annual reviews or helping you set up your client login so they can go about seeing their account on your website. I mean, things even as complex as that. I mean, we're going to be there for you every step of the way. So that's a great question. I'm glad it was brought up. We understand this is a very intricate, I think, side of a business that for a lot of people might be new, or if you're coming from somewhere else. I mean, no matter how knowledgeable you are, it's different when you go to a new system. So we definitely take seriously the responsibility of making sure that everyone we have on the platform is properly trained, properly educated, and confident, just because we think that's just better for everyone overall. And that's going to give you the best chance at growing your business. So it looks like some people are asking a little bit more about kind of studying. Studying for the Series 65, I will say it's not an easy test. I won't sugarcoat it. I'm not going to say it's impossible. We have a pretty good success rate of people that have signed up for it and passed it through us. And if you think about it, I mean, it's meant to be hard. If it was easy, there would be really no barrier for entry. Everyone would want to go ahead and do it, and they want to make it a little difficult just because it's an investment in yourself. It's an investment in your money. It costs about $165 to actually take the test. It's an investment in your time, meaning that it's probably, depending on how experienced you are, it's probably going to take you anywhere from 40 to 60 hours of studying to get a pretty good grasp of the information to make sure you're confident to pass. So it's definitely an investment in yourself. Not anyone off the street can just walk into a testing center and pass it. And frankly, that's a good thing, just because there is a lot of responsibility that comes with being an investment advisor. And that's why there is that securities license requirement. So For anyone who might want to go about learning more about getting started or talk to our team about maybe what study options are available, we do have an institutional partnership with Kaplan. They're one of, I think, the premier study resources out there. That's what our team here actually personally uses to get passed in the tests. That's what a lot of our advisors, I'd say majority of our advisors have used to pass. And they have things as simple as just a book and maybe online questions, or if you're a better person, or if you're the type of person, that learns better in person, they even have live class options available too. So they can customize it to really however you learn best. But if you have maybe specific questions for your scenario, give us a call. We're happy to discuss those too. So I'll give it a little bit longer for questions as people call in or chime in for questions. I'll go a couple more minutes. A lot of people are wondering about, let's see, what are the costs involved? Costs involved, I guess I'll talk about that in twofold. There's obviously advisor affiliation fees, meaning that as an advisor with IAMS Wealth Management, there is a cost that we charge our advisors to be part of our firm. Those are simply costs that we incur as a firm that we pass through to the end advisor, meaning our firm level E&O. We go ahead and include for each advisor. So you're going to have an E&O certificate as an advisor with IAMS Wealth Management. A lot of the technology that we have, we're able to offer to advisors at an affordable rate just because, we have the advisor base and the order quantity to make that possible. So we include proposal software. We include reporting systems for you to get ready for your client appointments. We include a CRM service if anyone out there maybe uses a CRM to kind of keep their database in line. We offer access to that. I can go through on a one-off basis if anyone's looking to know exactly what technology comes with the package, but that does cost overall on an annual basis $2,500 to affiliate with IAMS Wealth Management. So that's kind of that question there. Some people are asking then about cost expenses. I don't know if that was intended on the client side too, but I'll touch on that. Our fee schedule primarily is a wrap fee schedule. And if for someone who might be new to this side of the business, all wrap fee means is it encompasses trading costs within the fee structure. Those of you out there who might have your own individual accounts, you're probably used to investing your own money, making trades here and there, and then incurring maybe a trading cost or a trading commission when you're doing that type of trade. That's pretty common. In wrap accounts, that actually is just baked into the advisory fee itself. So we do have a negotiable wrap fee. On the firm side, our fee is 90 basis points for a wrap account, and that includes all trading costs associated with the platform. That includes the money manager costs that we talked about earlier, the active management of your account. That includes a lot of the support, the various systems that clients have access to, and that's kind of the core cost. Our advisors then, on top of that, can charge up to 1%. So the maximum fee a client's going to pay through a wrap account is 1.9%. I will say majority of our clients do charge that, and I think some people might be caught off guard by that at first, thinking 1.9, that might sound a little high. The truth is, in our kind of range of competition, in our range of other firms that provide similar services in a wrap format, we're one of the lowest cost providers out there, and on a one-off basis too. I mean, we're happy to go through some examples of how clients out there, we can actually give them a pretty good credit back on their fees if we're able to analyze current statements versus what we're proposing. More often than not, it's kind of exciting for our team to run through these proposals because we are a lower volatility option that is likely going to cost the client less money. So that's kind of our mindset there. Someone's asking about the fees for the Premier Advisor platform. That is a little different just because it's a little different format. There's no money managers involved outside of just the advisor's expertise. So I don't want to quote exact numbers, but it's not the 90 basis points. It's lower than that. Looks like someone, and again, I'll keep going just for a little bit, just because these questions keep coming in. I don't want to leave anyone hanging here. This will be kind of the last one I'll try to answer for now. But this is a good question. So someone asks about their current relationship they have with the broker-dealer. Can they affiliate with our firm on the RIA side for their advisory business? The short answer is yes, it's possible. It would depend on one, I guess the broker-dealer being willing to share supervision of you as an advisor. We've had conversations with broker-dealers in the past about kind of making something like that scenario happen. Some have been more than open to the idea. Some, don't want to touch it, and it's fine either way. We understand that there's a little bit more compliance to it if you're trying to dual supervise someone. So we've seen it go both ways. Secondly, though, you do want to make sure, I don't want to answer it blanketly that it's possible in every state, just because certain states do have different rules at the state level. So we'd want to work on your more individual situation there as well. But again, I mean, I can't say enough. I appreciate all the questions. I like that. Obviously, this is, I think, a hot topic. I think it's a smart way for people that might be looking for ways to kind of reignite business. This is, I think, an easy way to tie in asset management that maybe other firms can't quite match. So I appreciate the attentiveness of everyone that came. I appreciate the questions. These are really good thought-provoking questions. They're the right questions. These are the stuff we like to answer. So again, I appreciate that. I know we talked now, I think, for about 58 minutes or so here. We really just touched the surface of everything. Like I've said, we have our quarterly advisor meeting. So if you're someone who is with a firm elsewhere and you'd like to even just come see us, learn a little bit about us, meet us face to face, talk to some of our money managers, I mean, we have that option available. So definitely give us a call. Again, my name is Charles Heuring. I'm more than happy to talk through any of your questions with you. Or if you're just starting out, if you're thinking about this being maybe a new facet of your business, and you're thinking maybe the 65 isn't a bad idea. What I can tell you, like I said earlier, is that a lot of people who have kind of gone in your footsteps before you have really been thankful they've done this, just because of the marketability standpoint, it makes them a little bit more credible. I know nowadays more and more agents are mentioning that clients are asking, are you a fiduciary? Well, when you're aligned with a firm like IAMS Wealth Management, an RIA firm, you are a fiduciary. So that does give you a little bit of a distinct marketing point to make, is that you are a fiduciary. I could keep going on and on about the benefits. I mean, I think a lot of our advisors like the ongoing fee-based revenue. That is a nice complement to the existing commission-based business that you're doing on the insurance side, where everyone has those inevitable months that they maybe go through a slump, or they have a time where they just happen to take a month off for, health reasons, or if you want to take some time with the family. You're going to get that steady income month after month after month from your fee-based business. And then when it comes time at the end of the road that you're either going to pass off your business to someone else, or pass it internally or sell it to someone else, you have a valuable recurring revenue stream that's just going to make your whole business entity a little bit more valuable than it would be if it was just a block of commission-based kind of transactional relationships. So again, I apologize for kind of dragging on here, but I like to touch on that as much as I can. Again, I appreciate everyone's time today. Thank you again for taking time. I know it's a big deal for someone to take an hour, slot on an hour to listen to us do these webinars, but we do appreciate it. I encourage you all with any follow-up questions. I know I didn't get to all of them. I'll be reaching out to you individually, but also give our number a call. We're happy to help you out however we can, whether it's bringing you over as an advisor, starting you as an advisor, or just being a educational soundboard. That's what we're here for. We're here for you. So thank you, everybody. Enjoy the rest of your day, and we'll talk to you all soon.